The IRS punishes you for saving too much. The $150,000 retirement tax trap. Margaret retired at 66, after 32 years as a school administrator. She did everything right. She maxed out her 401k for 20 years. She never touched her IRA. She lived below her means. She watched her balance grow from nothing to $1.1 million by the time she stopped working. And then the IRS started punishing her for it. Not because she broke any rules, not because she cheated on her taxes, because the tax code is designed in a way that turns a large traditional IRA into a weapon the IRS uses against you. Every dollar Margaret saved is now a dollar the IRS controls. They decide when she takes it out. They decide how much. And every forced withdrawal triggers a cascade of taxes that she never saw coming.
In 9 years, when Margaret turns 75, the IRS will require her to withdraw over $44,000 from that IRA, whether she needs it or not. The forced withdrawal will push 85% of her Social Security into the taxable zone. It will add nearly $5,000 to her federal tax bill compared to what she would owe without it. It could trigger Medicare IRMA surcharges that add over $1,000 a year to her premiums. And the number gets bigger every single year for the rest of her life, because the RMD percentage increases with age even as the balance shrinks. Margaret did not make a mistake by saving. She made a mistake by saving in the wrong place. And the IRS is not going to tell her the difference. I am going to walk you through exactly how this happens, who it hits, how much it costs, and the 5 specific moves that can stop it. This is the most important math most retirees will never see until it is too late. Before I get into it, I need to be clear. I'm not a lawyer, not a CPA, not a financial advisor. Nothing in this information is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. If you're new here, this content is for one specific group: retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version your 401k administrator gave you. Not the version your employer's HR department explained in a PowerPoint. The real version with real numbers in plain English. Drop a mental note right now. How much is in your traditional IRA or 401k? You don't have to be exact. Just round to the nearest 100,000, 200,000, 500,000, a million, whatever it is. That number determines how urgent this information is for you. Let's get into it. The math that nobody shows you. The IRS does not tax your traditional IRA while it grows. That's the deal. You put money in, you get a tax deduction, the money grows tax deferred for decades, and the IRS waits. They wait patiently. They wait for decades because they know that at age 73 or 75, if you were born in 1960 or later, they get to tell you how much to take out, and every dollar comes out taxed as ordinary income. Required minimum distributions, RMDs, are calculated by dividing your IRA balance as of December 31st of the prior year by a life expectancy factor from the IRS Uniform Lifetime Table. At age 73, the divisor is mod 26.5. At 75, it is mod 24.6. At 80, it is mod 20. At 85, it is mod 16 mod. At 90, it is mod 12 point. Watch what that does to a $1 million IRA. At 73, the RMD is approximately 37 of what that say. At 75, even if the balance has dropped to $900,000, the RMD is approximately like $36,580. At 80, if the balance is $750,000, the RMD is approximately $37,129. At 85, if the balance is $600,000, the RMD is $137,500. At 90, if the balance is $450,000, the RMD is $36,085. But notice something? The balance is dropping every year. You are withdrawing money. You're spending it. The account is shrinking. But the RMD amount barely changes. It stays in the closest $36,000 to $38,000 range for decades. Because the divisor gets smaller every year, the IRS designed the table so that the forced withdrawal stays large even as your account shrinks. By the time you're 90, you are required to withdraw over 98%. of whatever is left every single year, whether you need it or not. Every one of those dollars is taxed as ordinary income. Not capital gains, not qualified dividends. Ordinary income, the same rate as if you earned it at a job yesterday. And if you miss the deadline, the penalty is 25% of the amount you failed to withdraw. Under the Secure 2.0 Act, that was reduced from 50%. It can drop further to 10% if you correct the mistake within 2 years. But the smarter play is to never miss it. Set up automatic withdrawals. Treat the deadline as non-negotiable. The first year trap. There's also a trap in the first year. If you turn 73 in 2026, you could delay your first RMD until April 1st of 2027. That sounds like a gift. It is not. If you delay to April, you must also take your 2027 RMD by December 31st of that same year. That means 2 full RMDs in 1 calendar year. Both taxable, both stacking on your return, both pushing Social Security into the taxable zone, both pushing you toward IRMA. The delay is almost never worth it. The RMD itself is not the punishment. Now let me show you what that does to the rest of your tax, because the RMD itself is not the punishment. The punishment is what the RMD does to everything else. Cascade. 1. Social Security taxation. The IRS uses provisional income. To determine how much of your Social Security benefit is taxable, provisional income, also known your adjusted gross income plus any tax-exempt interest, plus half of your Social Security benefits. For a single filer, if provisional income is below $25,000, Social Security is tax-free between $25,000 and $34,000. Up to about 50% mark, one is taxable. Above $34,000, up to what to call 85% is taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Those thresholds have been frozen since May 1983. They have never been adjusted for inflation. Now take Margaret. She collects $33,600 Social Security. She has no pension. She has modest savings interest of about $2,000. Without any IRA withdrawal, her provisional income is $2,000 plus $16,800, half her Social Security. $800. She is below the $25,000 threshold. Percent of her Social Security is taxed, but she needs income to live. She withdraws on $42,000, one from her traditional IRA. Now her provisional income is $42,000, on $2,000 plus $16,800, $6,800. She is deep in the quasi-subsidized by WAS OT 5% zone. $27,288 of her Social Security is now taxable income. That is $27,280 that would not exist on her tax return if the IRA withdrawal was not there. At the Commonwealth was variable percent rate, that's 3, that's 124, no, an additional federal tax. At 22%, it is $6,000 just from Social Security being pushed into the taxable zone by the IRA withdrawal. This is what financial planners call the Social Security tax torpedo. Every dollar of IRA withdrawal does not just get taxed at its own rate. It drags Social Security income into the taxable zone with it. The effective marginal tax rate on IRA withdrawals in this range can be 22%, 30%, even 40%. When you factor in the Social Security cascade, you are in the 12% bracket on paper, but you are paying 30% when in reality because of how the math stacks. Cascade. 2. Medicare. IRMA surcharges. IRMA is the income-related monthly adjustment amount. It is a surcharge on your Medicare Part B and Part D premiums that kicks in when your modified adjusted gross income crosses certain thresholds. For 2026, the first tier starts at $106,000 for single filers and $212,000 for married couples filing jointly. For Margaret, as a single filer, her income from Social Security, IRA withdrawals, and savings interest puts her well below $106,000. She is safe for now, but watch what happens as her IRA grows. If Margaret had saved $1.5 million Instead of $1.1 million, her first RMD at 75 would be approximately 61,000. Add that to her Social Security and savings interest, and her modified adjusted gross income is approximately 91,600 hostel. Still below the IRMA threshold, but if she does a Roth conversion of 20,000, in the same year, her income jumps to 106,600. Okay, she just crossed the $106,000 line by $600. The penalty for crossing that line by even $1 is not proportional. The first IRMA tier adds approximately $74.90 per month to her Part B premium. That is $898.80 per year, on top of the regular premium. And the IRMA determination uses income from 2 years prior. So a conversion she does in 2026 affects her premiums in 2028. Cascade. 3. The widower tax trap. If Margaret is married, the math changes for a married couple filing jointly. Standard deduction, $35,200. 12% bracket up to $96,950. IRMA threshold, $212,000. Everything is wider, more forgiving, more room. But when one spouse dies, the surviving spouse files as single the following year. The standard deduction drops to $100 plus senior addition. The 12% bracket shrinks to $48,475. The IRMA threshold drops to $106,000. The brackets get cut roughly in half, but the RMD does not. The IRA balance is the same. The forced withdrawal is the same amount, but it is now being taxed in a bracket that is half as wide. A married couple with a combined income of $80,000 in the 12% bracket can become a single filer with $70,000. In the finite 22% bracket must see overnight, not because they earned more, because they lost a spouse. The IRS does not send a condolence letter. It sends a higher tax bill. For retirees with large traditional IRAs, the widower trap is the most devastating tax event that nobody plans for. Real numbers. A married couple, both 75. Combined Social Security, $40,000 on. Traditional IRA balance, $800,000 now. RMD, approximately that 32 plus divide 20. Total income, $74,120, plus some savings interest. After the joint standard deduction of $36,300, their taxable income is about $200 yen. They are comfortably in the 12% bracket. Federal tax, about $48,800 at Palankian. The husband dies. The surviving wife now files as single. She keeps the higher of the two Social Security benefits, approximately $22,000. The IRA balance is the same. The RMD is the same. But the standard deduction drops to $8,151. The 12% bracket shrinks to $48,475. Her taxable income is approximately $36,370. That does not look much different until you realize the Social Security cascade changed too. As a single filer, the thresholds are $25,000 and $34,000 instead of $32,000 and $44,000. Her provisional income puts her deeper into the 85% zone than the couple was. Her federal tax jumps to approximately $5,100 at one bite. A $300 increase sounds small, but that is the first year. As the RMD grows and the IRA balance stays at the full amount, the gap widens. Within 3 years, the surviving spouse can be paying $500 to $2,000 more per year than the couple was paying together. Cascade. 4. The capital gains rate bump. This one is invisible to most retirees and it costs them thousands. In 2026, the 7% long-term capital gains rate applies to single filers with taxable income below $47,020, married couples below $94,500. That means if your taxable income is low enough, you can sell appreciated investments in your taxable brokerage account and pay zero federal tax on the gains. But when the RMD pushes your taxable income above those thresholds, your capital gains rate jumps from no percent to 15% mosaka. On a fiat 20,000 capital gain, that is $3,000 in tax that you would not have owed if the RMD had not been there. The RMD is not just taxing itself. It is pushing your capital gains into a higher rate, pushing your Social Security into the taxable zone, pushing your Medicare premiums into surcharge territory. One forced withdrawal creates 4 separate tax consequences. The paradox that should anger you. Here's the part that should genuinely anger you. The retiree who saved us $500,000. In a traditional IRA, and my $100,000 in a Roth pays dramatically less in lifetime taxes than the retiree who saved $600,000. In a traditional IRA and zero in a Roth, the same total savings, the same retirement, the same lifestyle. But the person who split their savings pays tens of thousands less. Because the Roth dollars are invisible to the IRS. They do not count toward provisional income, do not trigger IRMA, do not push capital gains into higher brackets, do not create RMDs. The tax code rewards the retiree who saved less in the traditional account and more in the Roth. It punishes the retiree who saved everything in one place. The person who saved everything in one place is usually the person who followed the default settings on their 401k for 30 years without anyone explaining the consequences. 2 retirees, same savings, wildly different tax bills. Let me make this concrete with 2 retirees. Both are 75. Both have exactly $600,000 in total retirement savings. Both collect $24,000 in Social Security. Both need $36,000 a year to live. Retiree A. Yassi has the full $600,000 in a traditional IRA. She takes her RMD of approximately $24,390 and withdraws an additional $12,000 around to cover living expenses. Total IRA withdrawal $36,390. Her provisional income is $36,390 plus $2,000 savings interest plus $12,000, half her Social Security. Akan is $50,390. She is deep in the 85% Social Security zone. About these $2,400 of her Social Security is now taxable. Her total taxable income after the standard deduction of 18 West Mifty Boss and White is approximately 38,640 Federal tax approximately $300. Retiree beat one has about $350,000 in a traditional IRA and $250,000 in a Roth. She takes her RMD of approximately $127 from the traditional IRA. She pulls the remaining about $22,000. She needs from the Roth, yes, tax-free. Total taxable IRA withdrawal $14,227. Her provisional income is $14,227 plus $2,000 plus $12,000. WAS $28,227. She is in the 50% Social Security zone, not the 85% zone. About $6,001, so $114 of her Social Security is taxable. Her total taxable income after the standard deduction, approximately about $291. Federal tax, approximately $219. Same total savings, same lifestyle, same Social Security, same age. Retiree A pays $4,300 in federal tax. Retiree B pays $219. The difference is $481 per year. Over 15 years of retirement, that is over $61,000. And that is just federal tax. Add state taxes, the IRMA exposure difference, and the capital gains rate difference, and the gap widens to $80,000 or more. That is the paradox. The system punishes the people who followed the rules the most faithfully. The 5 moves that fix. Now let me show you the 5 moves that fix this. All legal, all available right now. And the earlier you start, the more money you keep. Move 1. Roth conversions. During the gap years, the gap years are the years between your last paycheck and the age when RMDs begin. 73 if you were born before 1960, or 75 if you were born in 1960 or later. During those years, your income is at its lowest. You are not earning a salary. You may not be collecting Social Security yet. Your RMDs have not started. This is the most tax-efficient window of your entire adult life. During the gap years, you can convert money from your traditional IRA to a Roth IRA at dramatically lower tax rates. The money you convert is taxed as ordinary income in the year of conversion, but once it is in the Roth, it grows tax-free, comes out tax-free, creates no RMDs, is invisible to the Social Security taxation formula and IROMI for a married couple with no other income in 2026. The Bonity 12% bracket V allows approximately 96,900 of taxable income after the standard deduction. If their only income is from controlled IRA withdrawals, they can convert roughly 129,900 at a blended rate of about 10%. The math is staggering. A couple who converts 400,000 like over 5 gap years at an average rate of about 12% pays approximately $48,000 in conversion taxes. That same $400,000 left in the traditional IRA and forced out as RMDs at an effective rate of market will account 65% to 30% will down over 20 years cost them $100,000 to $120,000 in taxes. The conversion saves them $50,000 to $70,000 on the same money. But the gap years are finite. Every year you wait, the window shrinks. And once RMDs start, the conversion math gets harder because the RMD income fills the lower brackets first. Move 2. Qualified Charitable Distributions, QCD. If you are a kid about 70, 1 to 2 or older, and you give to charity, the QCD is the most tax-efficient way to do it. You can donate up to $108,000 per year. 2026 limit, directly from your IRA to a qualifying charity. That donation counts toward your RMD, does not count as taxable income, does not show up in your adjusted gross income, does not increase your provisional income, does not trigger IRMEA. Compare that to the standard approach. You take your RMD, the income hits your return, it pushes Social Security into the taxable zone, and then you write a check to charity from your bank account. You might get a charitable deduction if you itemize, but most retirees take the standard deduction, so the charitable contribution gives them zero tax benefit. With a QCD, the money goes directly from the IRA to the charity. The RMD is satisfied. Your AGI does not go up. Your Social Security stays less taxed. Your ERMAA stays below the threshold. Same donation, dramatically better tax result. If you are giving $5,000 or $10,000 a year to your church, your alma mater, your favorite charity, and you are not routing it through a QCD, you are handing the IRS money you do not need to hand them. Taxable. Move 3. Strategic withdrawal timing. Not all dollars are equal in retirement. The order in which you pull from different accounts has a massive impact on your lifetime tax bill. The general framework is this. In years when your income is low, pull from your traditional IRA and do Roth conversions. Fill the 12% bracket deliberately. In years when your income is high, pull from Roth accounts or taxable accounts with low embedded gains. Keep your provisional income below the Social Security thresholds and your MAGI below the IRMA thresholds. The key insight is that your taxable income is not fixed in retirement. You control it. You decide how much to withdraw from which account in which year. The retirees who treat this as a strategic decision save thousands. The retirees who pull from the biggest account on autopilot pay the maximum. Move 4. The senior bonus deduction. Recent tax legislation created a new deduction for taxpayers 65 and older. $6,000 per qualifying person. $12,000 for a married couple where both spouses are 65 or older. This deduction was specifically designed to offset the Social Security taxation problem. The income phase-out starts at $75,000 for single filers and $150,000 for married couples filing jointly. Below those limits, you get the full benefit at a cost of 12% rate. The deduction saves a couple $140 per year. It sees. At 22%, and it saves $2,640. This deduction is temporary. It runs from 2025 through 2028 only. If you have not claimed it on your 2025 return, file an amended return within 3 years. Ask your preparer specifically whether they applied the senior bonus deduction. If they do not know what it is, find someone who does. Move 5. Rebalance your account types before it's too late. If you're still working, you have one advantage that retired people do not. You can choose where your next dollar of savings goes. If your 401k offers a Roth option, use it. Every dollar that goes into the Roth side is a dollar that will never create an RMD, never trigger the Social Security torpedo, never push you into IRMAA territory. If you are between 60 and 63 down, the super catch-up provision allows you to contribute up to 1,150 not in additional catch-up contributions. If your prior year wages are below $150,000, those catch-ups can go pre-tax. If above, they must be Roth. Either way, the Roth option is almost always better for people who already have large traditional balances. The goal is not to have the largest retirement balance. The goal is to have the right mix. $1 million split between $600,000 traditional MAR and $400,000 Roth will generate dramatically less lifetime tax than $1 million all in traditional. Same total, different outcome. The IRS takes less from the split portfolio because the Roth portion is invisible to every cascade I showed you today. Bringing it all together, Margaret's plan. Margaret is 66 with a 1.1 million. In a traditional IRA, she has 9 years before RMDs start at 75. If she does nothing, her first RMD at 75 will be approximately $44,700. Combined with Social Security, that pushes her into the 85% SS taxation zone, adds approximately $3,400. In federal tax from the SS cascade alone, puts her close to the IRMA threshold where any additional income could trigger nearly madiwanasnatikas in Medicare surcharges. If instead she converts $80,000 per year for 5 years. During her gap years at the 2% bracket, she pays approximately $88,000 in conversion taxes over 5 years. That sounds painful, but it removes $400,000 from the traditional IRA. At 75, her remaining balance is approximately 800 suppliers instead of by 1.3 million. Her first RMD drops from approximately 45,000 liras to approximately 33,000 samadikstein. That lower RMD keeps her Social Security in the 50% zone instead of the 85% zone, keeps her below RMAA, keeps her capital gains in the 0% bracket. The lifetime tax savings from those 5 years of conversions, when you add up the lower SS taxation, the avoided IRMAA surcharges, the 0% capital gains rate preserved, and the tax-free Roth growth, exceeds to $150,000 over a 25-year retirement. Margaret saved $1.1 million. Over 32 years, the 5 years of Roth conversions save her $150,000 of that over retirement. Nearly now 14% of her total savings protected from the IRS by spending 88,000 Aussies in conversion taxes to save quite 150,000 Stossern in lifetime cascading taxes. The retiree who saved more paid more in taxes. The retiree who converted strategically kept more. That is the paradox, and the IRS will never explain it to you. What you should do right now. 3 things. First, look at your traditional IRA or 401k balance. If it is above yen to 500,000 yen, you're in the tax torpedo zone. The RMDs on that balance are going to push your Social Security into the 85% zone and potentially trigger IRMAA. You need a conversion plan. Second, calculate your gap years. When will you retire? When do RMDs start? That is 73. If you were born before 1960 or 75, if you were born in 1960 or later, how many years of low-income conversion space do you have? Every year of that window you leave unused is a year of conversions you cannot get back. Third, talk to a fee-only tax planner who understands the interaction between RMDs, Social Security taxation, IRMAA, and Roth conversions. Not a financial product salesperson, a tax planner. Someone who will model the next 20 years of your tax life with and without conversions. The difference between those two projections is the real cost of doing nothing. If this helped you see something you weren't prepared for, share it with someone who needs to know. And think about this. Which cascade surprised you the most? The RMD math? The Social Security torpedo? The IRMAA surcharge? The widow trap? The capital gains bump? That answer tells you exactly where your blind spot is and where you need to focus before it's too late.